The Federal Reserve continues to act aggressively on interest rates, pushing the US dollar to historically high levels against several currencies. Given that other central banks are also tightening in response to rising inflation, government bond yields are rising to levels not seen in years. Many currencies, including the euro, the Japanese yen, the British pound, the Australian dollar, the Canadian dollar, the Chinese yuan, and many other emerging market currencies have lost ground against the US dollar. The latest Fed move saw the central bank raise its upper limit target rate by 75 BP in September to 3.25%, the highest level in almost 15 years. Given rising annual inflation rates elsewhere, central banks in the eurozone, the UK, Switzerland, Australia, Canada, India, Indonesia, Mexico, Poland, and South Africa have also raised interest rates decisively. Underlying factors driving inflation continue to linger, and CPI annual inflation rates remain elevated and well above central banks' targets. Global financing conditions have tightened even further, and government 10-year bond yields increased significantly in many major economies, including the US, Germany, France, Italy, Spain, Switzerland, Australia, Korea, and Indonesia. The UK has seen a particularly rapid increase in 10-year gilt yields in recent months. Around the world, people are sharing Gamal's pain and frustration. An auto parts dealer in Nairobi, Kenya, a seller of baby clothes in Istanbul, Turkey, and a wine importer in Manchester, United Kingdom, have the same complaint. A surging United States dollar makes their local currencies weaker, contributing to skyrocketing prices for everyday goods and services. This is compounding financial distress at a time when families are already facing food and energy crunches tied to Russia's invasion of Ukraine. A strong dollar makes a bad situation worse in the rest of the world, says Ishwar Prasad, a professor of trade policy at Cornell University. Many economists worry that the sharp rise of the dollar is increasing the likelihood of a global recession sometime next year. The dollar is up 18% this year and last month hit a 20-year high, according to the benchmark ICE US Dollar Index, which measures the dollar against a basket of key currencies. The reasons for the dollar's rise are no mystery. To combat soaring U.S. inflation, the Federal Reserve has raised its benchmark short-term interest rate 5 times this year and is signaling more hikes are likely. That has led to higher rates on a wide range of U.S. government and corporate bonds, luring investors and driving up the U.S. currency. Most other currencies are much weaker by comparison, especially in poor countries. The Indian rupee has dropped nearly 10% this year against the dollar, the Egyptian 20% and the Turkish lira an astounding 28%. Rich countries are not immune. In Europe, which was already teetering toward recession amid soaring energy prices, €1 is worth less than $1 for the first time in 20 years, and the UK pound has plunged 18% from a year ago. The pound recently flirted with dollar parity after new UK Prime Minister Liz Truss announced huge tax cuts that roiled financial markets and led to the removal of her Treasury Secretary. Ordinarily, countries could get some benefit from falling currencies because it makes their products cheaper and more competitive overseas. But at the moment, any gain from higher exports is muted because economic growth is sputtering almost everywhere. A rising dollar is causing pain overseas in several ways. It makes other countries' imports more expensive, adding to existing inflationary pressures. It squeezes companies, consumers, and governments that borrowed in dollars. That's because the more local currency is needed to convert into dollars when making loan payments. It forces central banks in other countries to raise interest rates to try and prop up their currencies and keep money from fleeing their borders. But those higher rates also weaken economic growth and drive up unemployment. Put simply, the dollar's appreciation is bad news for the global economy, says Capital Economics' Ariane Curtis. It is another reason why we expect the global economy to fall into recession next year. Gyrating currencies has caused economic pain around the world many times before. During the Asian financial crisis of the late 1990s, for instance, Indonesian companies borrowed heavily in dollars during boom times, then were wiped out when the Indonesian rupiah crashed against the dollar. A few years earlier, a plunging peso delivered similar pain to Mexican businesses and consumers. The soaring dollar in 2022 is uniquely painful. However, it is adding to global inflationary pressures at a time when prices have already been soaring. Disruptions to energy and agriculture markets caused by the war in Ukraine magnified supply constraints stemming from the COVID-19 recession and recovery. In Nigeria and Somalia, where the risk of starvation already lurks, the strong dollar is pushing up the price of imported food, fuel, and medicine. The strong dollar is nudging debt-ridden Argentina, Egypt, and Kenya closer to default and threatening to discourage foreign investment in emerging markets like India and South Korea. For the rest of the world, it's a no-win situation, said Ishwar Prasad, an economics professor at Cornell and author of several books on currencies. At the same time, he said, the Fed has no choice but to act aggressively to control inflation. Any delay in action could make things potentially even worse. Policy decisions made in Washington frequently reverberate widely. The United States is a superpower with the world's largest economy and hefty reserves of oil and natural gas. When it comes to global finance and trade, though, its influence is outsized. That is because the dollar is the world's reserve currency, the one that multinational corporations and financial institutions, no matter where they are, most often use to price goods and settle accounts. Energy and food tend to be priced in dollars when bought and sold on the world market. So is a lot of the debt owed by developing nations. Roughly 40% of the world's transactions are done in dollars, whether the United States is involved or not, according to a study done by the International Monetary Fund. And now, the value of the dollar compared with other major currencies like the Japanese yen has reached a decades-long high. The euro, used by 19 nations across Europe, reached 1-to-1 parity with the dollar in June for the first time since 2002. The dollar is clobbering other currencies as well, including the Brazilian real, the South Korean won, and the Tunisian dinar. One reason is the string of crises that have rocked the globe, including the coronavirus pandemic, supply chain chokeholds, Russia's invasion of Ukraine, and the series of climate disasters that have imperiled the world's food and energy supply. In an anxious world, the dollar has traditionally been a symbol of stability and security. The worse things get, the more people buy dollars. On top of that, the economic outlook in the United States, however cloudy, is still better than in most other regions. Rising interest rates make the dollar all the more alluring to investors by ensuring a better return. That, in turn, means they are investing less in emerging markets, which puts further strains on those economies. The unusual concatenation of events, which has led to weakened global demand, is making things even worse for countries that might otherwise be able to take advantage of a devalued currency to export more of their goods, which have become cheaper. The most vulnerable face the biggest blowback. Poor countries often have no choice but to repay loans in dollars, no matter what the exchange rate was when they first borrowed the money. Spiraling U.S. interest rates were what set off the catastrophic debt crisis in Latin America in the 1980s. Despite the pain a strong dollar is causing, most economists say that the global outcome would be worse if the Fed failed to halt inflation in the United States. At the same time, the sweep of rising interest rates around the globe is causing concerns that central bankers might move too far, too fast. The World Bank warned this month that simultaneous interest rate increases are pushing the world toward a recession and developing nations toward a string of financial crises that would inflict lasting harm. The Fed's mandate is to look after the American economy, but some economists and foreign policymakers argue it should pay more attention to the fallout its decisions have on the rest of the world. We are now pushed against the wall. The Fed keeps printing money and the dollar keeps getting stronger against other currencies. If the Fed stops printing money, then the inflation would be worse than it is now, so it is now a matter of picking the lesser of two evils. What do you think about the current effect of the dollar to your local currency? Let us know in the comment section. Don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.